Our first category of ratios are profitability ratios. And the first thing you need to realize is that there's a difference between profit, which is simply revenues earned less expenses incurred, and that's represented in a dollar figure. That's different to profitability. Profit is simply the difference between two numbers, whereas profitability is taking that profit number and then comparing it to a base figure. So we'll call that figure X. And that is always expressed as a percentage. All that we'll do is for each ratio, we'll change what X is. So it could be sales, assets, or capital. And that as a percentage will be what we refer to as profitability. So to define a profitability ratio, it analyzes how profitable a business has been relative to a base figure such as sales, assets, or owner's equity. Looking at the share price, we've looked at the profits of Myer, Super Retail, and the Reject Shop and their subsequent share prices. Well, obviously the share price can't be based on how big their profit is because Myers is by far the biggest out of the three businesses, and it's about 8 to 9 times bigger than the Reject Shops. So the share price for Myer at this point was $2.44, whereas Super Retail was $9.43, and then amazingly the Reject Shop had the highest share price out of all of them. So that's not based on their net profit, it's based on what's called profitability. And the reason is the Reject Shop actually had a bigger profit compared to its sales than, say, Myer did. So that explains the share price. What we want to look at is 4 profitability ratios in particular. So we'll go through these each lesson for each one. And we'll go through the gross profit margin, net profit margin, return on assets, and return on owner's investment.